Today's ADP bombshell, 45,000 jobs vanished in October, proving, just as I've warned, the job market's cracking wide open. But get this, CEOs are suddenly the most optimistic they've been since 2007, even as they're handing out pink slips. Something here just isn't adding up. In small businesses, they're teetering on the brink of survival. They've been hammered by sluggish sales and skyrocketing costs that continue to squeeze their already razor-thin margins. Now, this ADP report isn't just a blip or a warning, it's a full-blown wake-up call that your job, your savings, and your entire way of life are hanging on by a thread. Now, stick with me because brushing this off could cost you everything you've got. And tonight's show is brought to you by Upexi. You can find them on the NASDAQ under the symbol UPXI, and they're revolutionizing value creation as a Solana treasury company, fusing customer brands with savvy digital asset plays to unleash massive investment upside. And if you're a trader, you're going to love this setup because their stock is parked right at that critical 10-day volume profile, sitting at around $3.30. It's prime territory to watch because a solid close above it screams a bullish breakout is ahead. Now stay tuned to the end of the show or check out the pinned comment or description for more information. Because I've been warning that this high-flying stock market was hiding the ugly truth about the economy, that demand was falling, margins were getting squeezed, and that companies were going to lay off more and more workers to protect their bottom lines. Now, that day is here. And with the official government data still MIA thanks to the shutdown mess, ADP has become our lifeline for what's really going on in the labor market. But heads up, as I've been warning, if this holiday season bombs out just like I'm expecting, these layoffs are just the opening act for the pain that's going to come in the first quarter of next year. As ADP reported that U.S. companies shed 11,250 jobs per week on average in the 4 weeks ending October 25th. That is 45,000 job losses in the month, not including government workers, which would be the largest monthly drop in jobs since March of 2023. Now, this late month deterioration is the real story here. It's piling on top of the Challenger Grain Christmas report that we just got back in October, where big corporations announced a whopping 153,074 job cuts. And the problem is, because of the way they're announced, they're not going to actually hit the real economy for another 2 to 3 months. So the University of Michigan Sentiment Survey was spot on when it said 71% of respondents expect unemployment to rise in the year ahead. That's now the largest share since 1980. So these worries, they're turning into a cold, hard reality with actual job losses stacking up by the day. And when you add in government workers, it gets even worse. Goldman Sachs estimates that U.S. payrolls declined by 50,000 in October. So this is the screaming nightmare scenario that no amount of Fed rate cuts can patch up because the labor market is breaking down fast. Now we're talking stagnation here. This is when you have high inflation and crumbling demand crush everything in sight. It's the absolute worst setup because it locks in a recession as the next stop. And my friends, that's the best case scenario. Now let's dig deeper into why this job carnage is no fluke as the economy's house of cards is starting to collapse piece by piece. Now let's start with small business pain because the National Federation of Independent Business Optimism Index declined 0.6 points to 98.2. This is now a 6-month low. And leading the decline is one of the biggest problems for small businesses right now. The net share of owners reporting stronger earnings in the last 3 months fell 9 percentage points than most since the pandemic and restrained by weaker sales and higher material costs. So what the problem is, they continue to get squeezed at the margin to the point where their survival now is becoming questionable. And here's the proof. Let's turn to this chart of advanced retail sales versus corporate profits after tax. And you can see in blue, the big issue going back to 2022 is that real retail sales have been largely negative for the past 3 years. And while large corporations saw their profits jump around 2023, a lot of small businesses didn't. So what you're seeing here, small businesses have been falling behind, meaning they're going to be forced to lay off just to survive. And this chart clearly shows that the net share of small business reporting higher profits has been negative prior to 2021, meaning once again, small businesses need a blockbuster holiday season, or the reality is going to set in that they're probably going to be forced to close their doors. Now, the overall index was also dragged down by less optimism about the outlook for the economy. The net share expecting activity to improve 6 months from now fell 3 percentage points to 20%, the lowest since April. So you pile on massive hikes from health insurance premiums that these small businesses are facing. It's not just a cash drain, it's making them uncompetitive against big players who can absorb those hits. So the issue here is when costs rise, sales fall, and optimism plunges, so too does the need for employees. However, there was a small decrease in hiring plans in the next 3 months, making it the first decline since May. And this is exactly what's been echoed by consumers in the University of Michigan Sentiment Survey. Let's turn to this chart of the University of Michigan Sentiment Survey, shown in blue against the unemployment rate in red. And you can see that when confidence comes plunging down, the unemployment rate rises. And that's a risk we're facing right now. You can see that big drop in confidence. It hasn't turned into layoffs, but it's coming soon. Because there's two clear signs that lead into a recession. You get collapsing confidence, followed by rising unemployment, and that's exactly where we're at today. Now, the report also showed actual and planned price increases fell, and that 30% plan to increase prices down a point from the prior month. The group's uncertainty index surprisingly dropped to the lowest level this year while remaining historically high. But what's the reason why? Because small businesses are starting to accept the harsh reality that this rough economic ride they've been on in the past few years isn't easing up anytime soon. In fact, it's probably getting worse, which is why uncertainty no longer is the issue. Because the reality is they want to jack up prices to survive, but they can't because the economy is weakening, and what this is going to do is force them to pump the brakes just to hang on. Now, a couple weeks ago, CEOs were sounding the alarm on sky-high valuations. They said stocks could come crashing down 10 to 15%, which would be healthy, and you should be happy about. Today, we get a whole different message. In fact, what they're saying is they're the least worried about an economic slowdown since 2007. And you can see mentions of economic slowdown and synonyms during sales, guidance, and earnings call tracked by Bloomberg have hit the lowest since 2007. And this is playing out as the S&P 500 heads for a third year of high returns, with stocks as expensive as they were at the post-pandemic peak. So what you're seeing here is pure denial mode by CEOs. This is exactly what happened going into 2008, right before everything imploded. But the data doesn't lie, because Goldman's layoff tracker spiked in October, suggesting that odds are rising half a point that unemployment could jump 20 to 25% in the next 6 months. So while CEOs suddenly have a change in tune, they're quietly cutting the ranks. And weak demand mentions have declined over the past year but remain above average, while the ratio of companies mentioning better or stronger versus worse or weaker has trended up. But is this just smoke and mirrors, telling investors that everything's golden, keep buying stocks, keep piling in, only to drop the bomb in the coming quarters when the reality really bites? Because the S&P 500 is on course for earnings growth of 14.5% this quarter, compared with the 7.4% expected before the season started. In fact, over 81% of companies so far have beaten the estimates. So here's the ugly truth. CEOs aren't sure how much longer they can continue to beat expectations. So they're hyping the good times to draw retail investors in while they dump shares at the top. Now, the S&P 500's forward price to earnings ratio surged to 23, equivalent to the post-pandemic peak and within the reach of a record hit prior to the dot-com bubble. So the reality is that this is something that retail investors aren't ready to handle, is that layoffs aren't bullish for stocks. And here's the ugly truth. Let's take a look at the NASDAQ 100 shown in red against the unemployment rate in blue. And you can see as the unemployment rate heads higher, which is exactly what the University of Michigan Sentiment Survey is forecasting, stocks come crashing down. Because without steady paychecks, consumers slash spending and start liquidating their stocks to cover bills. But if you think this party is going to go on forever, well, the rug pull is coming, my friends. The strong reporting season has kept analysts bullish in the U.S., with a Citigroup earnings revision gauge mostly in upgrade territory since the summer. Current earnings reports reinforce our core thesis. Profits remain the glue for U.S. equities, this according to Societe Generale SA strategist Manish Kabra. The raw truth behind these CEO layoffs? They're scrambling to defend profits and prop up stock prices at all costs. But if the consumer pulls back this holiday season and the unemployment rate surges and small businesses fail, analysts are going to turn bearish and this bubble is going to pop. Now, this shouldn't be a reason to panic, but to react before it's too late. Now, let's break down exactly what you need to do now before the labor market breaks and takes the stock market with it. Now we pull back the layers on this economic storm, and now it's time for the real payoff, because this is your cue to armor up before the labor market fully cracks and drags stocks right down with it. First off, I want you to build that ironclad emergency fund. Target 6 months of expenses in cash or safe havens like high yield savings accounts. Number 2, diversify your portfolio pronto. Shift some weight into bonds, gold, defensive stocks like utilities, consumer staples, things that hold up in downturns. And third, don't sleep on side hustles. Start one now, whether it's freelancing or the gig economy. Do this to create multiple streams of income. Because remember, knowledge is your ultimate edge. Act today, and you'll come out of this wealthier than most. And something we're bullish on, that's the stock for our sponsor of today's show, Upexi. You can find it on the NASDAQ under symbol UPXI, and they're a hybrid public company that owns consumer brands while focusing on building a Solana treasury to drive shareholder values through accretive capital raises, staking yields, and discounted token purchases. Solana, launched in 2020, delivers ultra-fast, low-cost transactions via proof of history, leading in active addresses, daily transactions, and DEX volumes while powering finance, gaming, AI, and more in a decentralized ecosystem. Like MicroStrategy for Bitcoin, Upexi provides public market exposure to Solana through equity, enhancing value with risk-prudent practices such as native staking and diversified validators to outperform SLO's price gain. As of October 31st this year, Upexi holds over 2 million SOL valued at $397 million with a $72 million unrealized gain. Adjusted SOL per share up 82% since launch and a 96% return for April 2025 private placement investors. And recent advisory additions like Solana influencer SOL Big Brain and investor John Najarian bolster ecosystem ties, while staking generates about $75,000 a day at a 7 to 8% yield. Upexi's flywheel uses accretive equity and debt issuance to acquire more SOL, compounding value through staking rewards, price appreciation, and built-in gains from discounted locked tokens, all managed with capital market expertise. Led by CEO Alan Marshall, he's a founder of a $14 billion XPO Logistics, and CSO Brian Rudick with deep crypto and finance expertise. Upexi bridges traditional markets and Solana innovation for a compelling play on blockchain's growth. Now let's take a quick look at the price chart here, because you can see their stock is parked right at that critical 10-day volume profile level, right around $3.30. And again, this is prime territory to watch, since the solid close above it screams a bullish breakout potential. Now I want you to visit Upexi.com to explore this hybrid opportunity at the intersection of consumer brands and Solana's expansions, and be sure to check them out on the NASDAQ under symbol UPXI. And as always with any company you feature on the show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades, and use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.